Welcome to the Commonwealth Home Ownership Podcast, the real estate investing podcast for Canadians. Whether you're a seasoned investor or just getting started, you've come to the right place. If you're looking for a way to take control of your life through real estate investing, stay tuned and be sure to join us at cwho.ca, your hub for all things real estate investing in Canada.
Hey everyone, welcome to another episode of the Commonwealth Home Ownership Real Estate Investing Podcast. This is Phil Wong. With me as always is Brad Price, and joining us again is Kim Nguyen. Hey Kim.
Hey guys.
How's it going, Kim?
Good, busy, hot season and hot weather too. So the perfect storm, I guess, too.
Are you going to at least have a chance to take a summer vacation this year?
With this rate, no, I don't think so. Maybe I'll go to Banff. I know it sounds so cliche, right? You live in Calgary, you go to Banff, but that's my best choice right now.
Oh, better than nothing, I guess.
Yeah,
for sure. So last time we discussed, the upcoming rule changes with the qualifying rate going up and everything. So now we're a few weeks into June. How have you found the qualifying rate has affected home sales at all at this point?
honestly, I feel like the intention, as you guys know, with the new qualifying rate changes is just to kind of cool down the market. But if anything, it hasn't really done much, to be honest with you. I'm still seeing a lot of clients buy a home. I'm still seeing a lot of competing offers, to be honest, which is it still baffles my mind, especially in Calgary. But overall, in general, I don't think it's really slowed anything down. I think if anything, it's pushed some people out of the market, but not many.
Okay, I think what was the estimate? It was like 4 to 5% of the people, right?
Exactly.
Which is not that many. Have you noticed maybe the higher house prices have those been affected at all? Anything above $500,000?
Not so much, still going strong. So if
Okay.
anything, I'm seeing a little bit more luxury sale homes, actually being bought because they think that this is kind of the bottom now. It's reached the bottom, it's only going to go up. So I've actually seen an uptick in that, which is, again, it's great news. That means green shoots. I'm hoping anyways that it's green shoots, especially in Alberta. But yeah, it's picked up for sure though, compared to last year. Oh, huge changes.
Well, I mean, I feel like everything compared to last year is a positive at this point.
Yeah.
So if it's still crazy out there, Kim, how long is the turnaround time right now for most banks to go through that application process, confirm everything, provide a commitment, and then be in a position to fund?
I'll be completely honest with you. It's been crazy. And the thing is, the turnaround time right now, and this is across all lenders, okay? Every lender is slammed because number one, with the increase of activity in the resale market, new builds, like people just buying a home, that's increased. And a lot of the lenders, they didn't feel that this would happen. So even before COVID, believe it or not, there were a lot of lenders that actually let some underwriting staff go because they didn't think that the demand would be here. So what has ended up happening is, you let people go, like critical staff go, and then now we have this crazy housing market, and you don't have enough staff to handle it. And on top of that, with lower rates as well, we're seeing an influx of clients who have existing mortgages who want to break it and do a refinance. So you've got business coming from all different angles, and you let go a good chunk of your staff before during the pandemic. So now trying to bring them back up, you got to go through the training process, and some of the critical staff, they've gone on to other industries. So what we're seeing now, I'll give you an example. With the credit unions right now, they're running at about a 9 business days just for someone to pick up your deal and look at it. If there's an adjustment that they need to be done, maybe they pick up your deal and they say, Brad, what, I don't like this. I think I need to add a co-signer, or you need to increase the down payment to make the deal work. It goes back into the bottom of the queue again, and now we're waiting again another 9 business days. So, that's one example, credit unions. Then we've got the bank lenders. There's one big bank here, I won't name the color, but right now their mortgage specialist staff and even their branch staff are telling clients, if you're looking to do a refinance, I will not get you an answer until 3 to 4 weeks. So listen to that. 3 to 4 weeks before you actually get an answer. You get an answer of someone who actually reviewed the deal. And it's the same process too. Like once they reviewed it, if there's something wrong and they don't like, it goes back to the bottom of the queue again. And you know what? Maybe you'll be lucky that they'll pick it up in a week or maybe 2 weeks, and maybe it won't be the full 3 to 4 week turnaround. But again, just for that initial pickup, it's going to be 3 to 4 weeks because, again, these lenders right now, with the influx of business coming in, they have to prioritize. Purchases go first, refinances go back, they're secondary. But if you do have a purchase, though, with most banks right now, we're looking at anywhere between 1 to 2 weeks, 1 to 1.5 weeks just for a review. That's the general consensus. But again, some banks are worse than others.
So just on the refinance part, if I can for a second here, or even just the renewal part, because so I had a conversation with a lender today with one of the big banks about a mortgage that is coming up for renewal in October, and I'm within the 120-day period that I have within the mortgage terms to actually start that conversation. And the initial before I kind of got set up to have a meeting or a call or what have you, the initial conversation was just call us back when you're a month out from that point in time when your mortgage renews. And I said to the gentleman, I said, I think I'd rather start a little bit earlier just in case I actually need to look at an alternate lender to whether I'm going to renew or not with you, or whether I'm going to look to an alternate lender to fund or take over this mortgage. And I just thought that was interesting that they had said, call us back with 30 days out. I thought to myself, if I did that, if I had listened to that gentleman and proceeded in that manner, I might find myself in a very precarious situation for the simple fact that nobody else could maybe review that mortgage in time to actually fund it with anybody else. So I could end up in a situation where I have to basically renew with the current lender. So in terms of, I guess, whether it's a renewal or you're looking to, you're coming up to the end of a mortgage that you may have, what is the typical time frame that people can start the process? Is it 120 days across the board? Is it different for each lender? Like, what does that look like, Kim?
It's always 120 days, right? So when you are 120 days out from your renewal, that's when you can start shopping. That's when you can start the refinance process. And one of the reasons why, Brad, that they said, hey, come back in 30 days, the main simple reason is because they know that if they submit your deal now, you're just creating excess backlog. They just don't have the capacity to deal with your deal. Like, as unfortunate as that sounds, they're trying to prevent that, right? They're trying to kind of get everything that's already in the queue just pushed through. So it's unfortunate, and it's hard to say, because if these trends continue where we've got such a hot housing market and low interest rates where everyone just, everyone under the sun and moon wants to break their term or just transfer their mortgage at renewal, this is what happens, right? There's just too much business going in and just not enough bodies to handle it. That's why my recommendation for any client is, if you do have a renewal, start it at the 120-day mark. Like, start it, right? Don't waste any time, because the risk is that if you actually took that banker's advice and waited until you were 30 days out, what if this situation hasn't improved? Like, what if general lender turnaround times are 3 to 4 weeks still? Then you're hooped. Because another thing they have to consider is, most clients aren't aware of this, but it's really important to read your contract, especially when you're coming up for renewal, because there's certain banks where by the renewal date, so let's say your renewal date is August 1st, if you haven't done anything with that bank, what they will do is sometimes they re-renew you back into the same term, or if not, they'll renew you into a closed term where even if you were to transfer the mortgage one day late, like let's say August 2nd, you got to pay a penalty. There's no way out of it, right? Even whether it was your fault or a delay on the other lender's fault, where they're trying to, take that mortgage and transfer it over, you got to be really careful. There's certain lenders that say, well, we haven't heard from Brad, we haven't heard from Phil, like based on the terms, we're just going to re-renew you into a close rate term. That's that. So be careful of that trap. It's actually happened quite a bit. So and it's heartbreaking, right? And it's just, there's only so much that you can do as a consumer. Like, there's only so many people that you can push, right? And ultimately, your mortgage professional, there's only so much that they can do too. If lenders are slow, lenders are slow.
Could it be that there's an ulterior motive for these lenders to tell you to renew so late,
Could
just
be.
so you have to stick with them because you don't have
Yeah.
a chance to shop around.
That's true. Yeah, conspiracy theory, right? I'm pretty sure like it could be a tactic. It's a great one because by that time, honestly, like it'd be too late, right? You'd be stuck with them.
Hmm.
Yeah, absolutely. I think that's really, really fundamental that it's elemental that people know exactly what they're getting into, what they're signed up for, and the terms and conditions in their mortgage agreement. Because I mean, Kim, you must see that all the time where people either forget, they don't realize, or they just don't know.
Totally. And I see like one of the big things as well too for investors. And I know, like I said, there's a lot of investors listening on this podcast. One key thing, the one common mistake I see a lot is, at a certain point in time in any investor's journey, you get hit with the financing wall, right? Like we all hear about it. Like you have too many properties, and at a certain point in time, you have to commercialize your portfolio, right? And the one thing that you have to be careful of is that there's certain lenders, like during the time period of when you're looking to commercialize your portfolio, you want all of your properties to line up accordingly, right? So when you make that transfer, you're not paying an arm and a leg for a penalty. But keep in mind though, depending on the lender, there's certain lenders that don't allow you to renew into an open term, right? So that's something to be mindful of. Like if you're getting close to that financing wall, and you want to look into the commercial realm, just make sure like the mortgages that you currently have already allow you to renew into an open term, because that will be very critical. I had a case where, again, same thing, like she had a mortgage with Tangerine, and the mortgage at Tangerine, believe it or not, they don't have open terms. So if they don't hear from you at the end of your term, they will literally auto renew you into the exact same term. So if you picked a 5 year, they'll renew you back into that.
Hmm. Okay, noted. And that's a really good advice. So for those who are listening, yeah, make sure that if you're close to the financing wall, just yeah, make sure you're with a bank that can renew into an open term, or at least make sure all your ducks line up so that they're all at least renew at or around the same time.
Exactly. And like I said, it works with even, clients that have upcoming renewals. If you want to switch to another lender for better rates, promos, just make sure you're on top of it. Do it earlier. Like give yourself ample time, because again, it's the same scenario, right? If your mortgage renews or matures on August 1st and August 2nd, you're planning to, escape from them. That's when all the paperwork is funneled through. You got to pay, you're forced to pay a huge penalty, right? Even though it's just one day.
Mm-hmm.
It kind of leads me into a question there, Kim. You mentioned the word paperwork, and how can people, whether they're just new investors or investors alike, how can people be better prepared or organized? What can they do with their paperwork to help them put their best foot forward if they are looking to actually go out to the market to get a new mortgage or work with someone like yourself to go through the renewal process or set something up? Like what's a way that they can do that and organize their paperwork?
I always say, right now we're in the digital age. So just whenever you get important documentation, and when a piece of paper comes into the mail and you're like, I think I should probably keep this, AKA your property tax bill, lease agreements that have been re-signed, updated, your notices of assessments, your T1 generals that you get from your accountant. Whenever you have those really key critical documentation that you'll most likely need for something, upload it into a drive, whether that be OneDrive, Google Drive, Dropbox. Having it readily accessible will really help you in terms of financing, because when the time comes, you're not scrambling last minute saying, oh my goodness, where's my property tax bill? Like, I think I probably threw it out in the recycling. Now you're kind of, sorting through a bunch of paperwork. That's why I always recommend the best, being organized will really, really help you out. And by being organized, the easiest thing to do is when you see it, take a picture of it on your phone. Like we're all attached to our smartphones. Download like an app like Tiny Scanner or Cam Scanner, where it automatically converts the picture to like a PDF, and then just upload it to one of your OneDrive, Google Drive, whatever you use. That way you have it. And when you're working with your mortgage professional, they're going to ask for those documents. It's easy to be like, here's the link. Here's all my documents. And it's one of those things where it just helps all parties, because if you can be a little bit more organized with your paperwork, it will help your mortgage professional as well.
Yeah, I mean, I actually invested in an actual document scanner. So sometimes I find that it just, especially when you're starting out, you have a lot of documents and you just want to get through all of them, and doing it with a camera one page at a
Yeah.
time is just super painful. So I bought uh, I mean, I bought the ScanSnap S1300i. That's what I've been using.
Fancy. Yeah.
No, it's pretty good. Like, it scans both sides at the same time, so you can have like a stack of 30 pages, stack them on, hit a button, and it'll
Yeah.
just go through them in like 10 seconds.
Yeah,
Yeah.
exactly. And again, like that's the best thing to do, right? That
Hmm.
like especially in a busy market, the last thing you want to do is be unorganized with your document because you got to remember too, your mortgage professional most likely they'll send you a list of things that you'll need. The quicker you can get it over, the quicker that they can do their job too. And right now it's a little bit of a race, right? The sooner you can get it to the lender, the better it is. And the key thing to remember is because lenders are so busy right now, some of them won't even review your deal unless you have the full package up front, right? If you're even missing a pay stub, they'll send the deal back and be like, well, no, you're still missing this. You didn't pass the triage stage. And in that case, now you're going back to the bottom of the queue again. So it's very important to have everything up front. That way it creates a smoother experience. We can get your stuff over to the lender quicker and all will be better. All will be good at that point.
Hmm. Yeah. In my opinion, I feel you should just scan everything.
Yeah.
Digitize every document that comes in for any of your properties. That way, when it's time to renew for a mortgage or apply for a mortgage, everything's already there on your drive. It's nice to have it, open like a G Drive or a Dropbox or something you can access from multiple locations too. I find that super helpful instead of having it
That,
all on your hard drive on your computer.
yeah, that's definitely one of the most beneficial aspects is that, there's always a situation where you're working on a deal or maybe you're traveling or you're driving around, you're out and you get asked, hey, I need this document. You missed it or you forgot it, whatever the case may be, or it's been requested. And you can go straight away to through your smartphone, your cell phone, and you can just share that document or send it off from where you are in real time and just get it done. There's no, okay, well, I'll be home in 8 hours and you'll have to wait. Like in this day and age, like you said, Kim, with application process taking so long, in some instances, like you can't wait all day just to send off one document because your application is literally stalled until that document is received. And if you're at the bottom of the pile, you're like, it has to be treated with such, in such a high priority manner.
Hmm. And I think it's also super important to just send more than you think they need.
Mhm.
Right? I think it's that way you don't have to. Yeah, it's just they have everything and more, so they don't have to go back to you to ask for more documents, because every time they do that, that could delay it by a few more days.
Exactly. And
I,
that's key. You don't want to get to the bottom of the pile, right? If a lender's saying, hey, I need this, like my goal is I'll call my client, I'll pick up the phone, I'll text them like 911 emergency, like, especially if you're in a competing situation, right? And that's a
Mm.
reality that we're in right now. If you're buying a home, like everything's so competitive because chances are there's probably a backup offer, right? Like chances are high that there is a backup offer. And if you need to ask for anything like an extension to your financing condition or extension to closing or whatever the case is, you may lose the deal that way. And we don't have to, we can't do that. We can't afford that.
So, Kim, let's flip the script here a little bit. What are lenders getting more comfortable with Alberta purchases again? And I'm specifically referring to investment property purchases because last year was a complete whirlwind, and it just felt like there was so much up in the air when it came to policy, when it came to even just the information that we were getting back from the lenders. Well, they're not sure if they're going to do it, and they're going to change their policy, and all of a sudden, yeah, they did change their policy, and some lenders said we're simply flat out not lending any more money for if you've already got a few properties in this area, whatever the case may be. Like, is that is that changing now? Is that comfort coming back?
The comfort is coming back, but again, it's like what I mentioned, I think previously too, it's slow, like it's very slow. It's still exception basis, but at least they're open to it. They haven't made any like new releases saying that, yeah, we're completely open for business in Alberta. They haven't vocalized that, but if there is a deal there, like it's at least now when we send it in, we're not getting shut down right away because it's Alberta, right? There's no pushback on that. It's more so, "Oh, okay, it's Alberta. All right, things are getting better. Let's take a look at it. Let's take a deeper dive into it before we just say completely, no, right?" So that's always a good sign, I find. Again, you have to remember with lenders, they're very, very slow at things, right? When they're introducing things, everything is very slow. It's not like an instant. Whenever it's opening up policies, making things a little bit easier, in favor of the actual client itself, just always remember it's slow, right? It's baby steps. But when they need to make it hard for us, it's quick. It's very, very fast. We won't even have time to argue with them, right? It's just done, just like that. So it's weird, right? It's one of those weirdest. It's like gas prices. I compare it to that. Like when gas prices are going down or should be going down, it takes forever for other gas stations to go down. But the moment that everything's up, that gas station is up like the next second, right? They don't waste any time. So it's kind of similar to that.
Yeah, it's kind of hard to argue with the banks and the gas stations.
Yeah,
Yeah.
right.
Yeah. Okay. I have another interesting question here. So I had a conversation today with a gentleman based out in North Vancouver, and he was asking me some questions just about the lending world. And I found it interesting. He made a comment about the bank that he currently banks with actually recommending or pushing him towards getting an insured mortgage and putting 19% down rather than putting 20% down. And my question is, are you seeing this? Is this a real thing right now with the banks because they want their loans insured because of uncertain times ahead? What's happening there?
Twofold. It's unfortunate because some banks will kind of push clients down that road because insured mortgage rates, we all know that it's much lower than conventional rates. So if you are looking to get the best interest rates in the market, hands down, if you're buying a home with less than 20%, you'll get it. And sometimes the difference, depending on the lender, it can be really big. Some of them could be, as low as 10 basis points, but some of them could be as high as 30 basis points. So sometimes, for clients going into one of their major banks, I find that some bank reps will suggest the idea of, hey, like, why don't you do 19.99% down payment or whatever, and then this way it gives us the ability to give you a lower rate. And the thing is too, like sometimes that lower rate doesn't really make sense, that the amount of premium that you're going to be paying, right? Sometimes you're better off just doing the 20% and not paying a premium. But yes, your interest rate is slightly higher, but you got to do the math, right? You got to really break it down to see it makes sense. So that's one part there. The second part is, it is true, like lots of lenders right now, they love insured mortgage because insured mortgage business is a healthy book in their opinion. They have nothing to lose. If something were to happen where a client can't pay their loan or anything, the banks, basically say, well, this isn't my problem. It's insured, right? It's not my problem. I'm going to get paid out anyways. So there is a bit of an incentive for the banks to have more insured business than not. But at the end of the day, I know sometimes it could be a sales tactic too from the mortgage professional side, because if you've got a client coming to you saying, I want the best rate, I want the best rate. Well, I can give you the best rate, but you got to do 19% down. So kind of another way of looking at it.
Speaking of rates, Kim, where are they kind of sitting right now in terms of insured versus uninsured?
Yeah, I'll give you an example. Okay. So on a deal like a 5-year fix, so
Okay.
insured wise, there's lenders, a generic rate would be 1.84%, 5 years fixed. Whereas if you were to take like an actual conventional rate, so meaning you're buying the home with 20% more, 20% down payment or more, and you're using a 30-year amortization, that rate will then jump up to 2.34%.
Wow, that's huge.
huge, right?
50 basis points. Wow.
Exactly. And again, like I said, it varies lender to lender because some lenders will just be maybe 10 basis points higher. Maybe their insured rate will be like 1.94 and then their uninsured rate would be like 2.04. It really does depend. But again, like the gap there, it's different between lender to lender, but usually it's anywhere between like 10 to 30 on average.
Okay.
Is there a limit, Kim, to how many insured mortgages you can get in
Yes.
totality, and B, hold at any one time?
Two insured mortgages. So there are three insured. So technically you could get three, but usually at that point it does get a little tricky though, right? Because it becomes like an exception basis. Because the one thing that you have to remember is at that point in time, the insurer will look at your overall portfolio and they'll want to assess you. They'll want to review the amount of risk, how risky your portfolio is. And at that point, if you don't have a lot of equity built into, your first and second home that is already insured, the chances of them insuring another home it'll be very slim because the risk is too high.
So if you, let's say you have two insured mortgages, and you're five years down the road maybe, and you refinance those based on your loan to value being 80%. So now you've got traditional mortgages. Could you at that point go and then get another insured mortgage?
You can, yes, because at that point, what happened is when you refinance your insured mortgage, you're getting rid of the insurance completely, right? It's wiped, it's gone. The moment you refinance it, it's completely gone. So at that point, it looks like you have no more insured mortgages. All you have are conventional mortgages.
But would the banks, because you have more than one or two homes, not give you an insured mortgage just because it's reserved more for the first-time home buyers?
It can be, yeah. So that's why usually when you grow your portfolio, like when you have a few rentals or a few properties under your belt, to get an insured mortgage can be challenging. It will come with its challenges because one of the common things that we see from the insurers, they'll say, okay, well, Phil, you've got like 5 homes already. Like you want your 6th home to be like an insured mortgage. Like that's kind of risky for us, right? And the key thing that you have to remember is they'll take a look at a few things such as your equity position in the existing homes. If you're really at the cusp and like, maybe your property values have gone down and you don't really have a lot of equity, that's an easy basis for them to decline you and be like, no, you're too risky for us, right? If any of your rentals were vacant and you had to sell it, like you don't have much left, right? So that could be a ground for them to decline you. Another thing as well too is the rents, right? If they're all rentals, they'll want to see how the performance is. And if they see the performance isn't too strong, or if they think that your values are a little too inflated, like maybe your rents are above market rents, like they will dive into these little things, like they'll nitpick it. And if they see that, that's another grounds for them to be like, no, like if you want to buy another home, do 20%. You're too risky for us.
Okay.
So is the stress test playing into this at all, Kim?
It is, unfortunately, because you got to remember too, with them, it is really more intended, this program, like to do a down payment less than 20%. It really is there to promote home ownership first and foremost, right? And it's really there for those who are looking to own their first home or just own their own primary residence, and they don't have the traditional means to do the 20% down. So that's kind of that's the whole mandate behind that. That's why when you have like 5 rentals or 5 properties already, you're looking to get an insured property. That's when they got to really assess, like, okay, is this a client that we want to take on? Is it too risky? Like, or should we be kind of saving this kind of stuff for someone who really, like someone who's a first-time home buyer who, they just want to get their foot into home ownership. So I would say stress test definitely plays a key role into it.
Mm-hmm. And just a little bit more background on insured mortgages for those who are not familiar. There's 3 primary mortgage insurers in Canada. Is that right?
That is
So
correct. Yeah.
there's CMHC, Genworth. I think they changed the name recently to Sagan. Yeah. And the third one is was it Home Trust?
No, Canada Guarantee.
Guarantee. Okay.
Yeah.
Are you familiar? Do they have different insurance rates?
No, It's the same.
All the same. Okay.
Yeah, the only difference between the three, and it's a common question I get asked, because sometimes a client will see the commitment and be like, "Oh, this isn't CMHC. Like, who is this?" Right?
Hmm.
But there's three insurers in Canada. They basically do the same thing. The main difference between the three is some of them have slightly different policies, right? And again, it's very slightly, it's very small differences. Like for an example, Genworth, aka Sagan, like for them, they didn't like it if you were buying a second home that had a suite in it. So if you're buying a second home, let's say for your family member, so let's say, parents were going to live in the top and then they're going to have a mortgage helper in the bottom, they're going to rent a basement, and then sure, like, Genworth, aka Sagan, they don't do those, right? Whereas CHC will do it, and same with Canada Guarantee. So it's like really small things like that. And then some of them, allow borrowed down payment, whereas some don't. So there's, like I said, very small differences, but when you're comparing it apples to apples, like the premiums, it's all the same.
Okay. Because I was reading that CMHC, they actually have stricter underwriting policies than the other
They do,
two.
they do.
Yeah.
They were the ones that changed. Like if you guys remember back in summer when Evan Siddall, the CEO or former CEO of CMHC, he announced that, oh, we're gonna head for some tough times. Like I'm gonna change my rules here. He changed it, but then all the other insurers they did not follow suit.
Because I believe, what was it? The TDS, they dropped it from 44 to 41, right? And GDS from 38 to 35.
Yeah,
Yeah.
exactly. And then also credit score, you cannot have a credit score below 680. You need to have a
Okay.
credit score above 680 to be considered. But
And what are the what's the limit for the other insurers? Do you know? I can't remember the.
yeah, so again, it depends on credit. And like some of them will go to a score as low as 600, 620. Like we've had that happen in the past. But again, all with good reason though, right? Like if it was
Mhm.
a complete error, like someone really ruined it, you have proof and stuff, that's the kind of situation that they would look at. But usually if you have good credit though, we're looking at the GDS of 39 and then TDS of 44.
Okay.
So Kim, I have a question in regards to the B space. So back when the stress test was initially introduced, it was mandated we'll just say mandated with the big banks. Okay, so then you have all these B lenders, monolines, and kind of those type of lenders were not mandated to utilize the stress test. They were a little more free to go about their business.
Mhm.
So their business picked up. Is the same thing happening now today with the B space?
It is. And one thing to clarify too, the B space, they still get impacted by the stress test. But what makes them a little different is that they have the ability to stretch the TDS, right? They have the ability to stretch the GDS. And that's what makes them different because most banks, they're bounded by like the 44 rule. That's kind of like a hard stop for them. Sometimes we can get an exception up to 50. It just really depends case by case scenario. But when we're playing in the B space, there's even some that even though you have to stress test the mortgage, you can go up to 60 TDS. Okay. I had a deal that was 61 TDS, and all with a good reason, they'll do it. But the one thing that most clients, the general public doesn't know is that to step into the B side, it's not like anyone can step into it, right? The first criteria is that you do need to have a minimum down payment of 20%, or if you're doing a refinance, there has to be minimum 20% equity in your home in order to even consider them. So if you have a down payment that's 10%, no, like you're stuck in the insured sandbox, right? This is the sandbox that you have to play in. But when you have 20%, that's when your doors open to the B side. It is still stress test, but again, the GDS TDS requirement is so much bigger than traditional lenders.
Good to know. So, I mean, in closing, Kim, for this month's market update, what tips do you have for people in regards to the new stress test, the new regulations that people are facing? What would you say?
I would say the one key takeaway is if you are again in the market, just be prepared of these long turnaround times, right? People think that you can get things done instantly and things get turned around really fast, but it doesn't. In reality, everything is really busy and tied up right now. Will it get better? I don't think so. If this market still continues, I don't think it's going to get better. So be prepared. So if you are in the market shopping, get pre-approved, right? At the bare minimum, just get pre-approved before you put in any offers. offers, because if you've done the pre-approval, chances are your mortgage professional has gathered most of the documents from you already. So that way, when you put an offer, we're not scrambling for a notice of assessment at the 11th hour. We don't want that. That's the last thing that you want. But yeah, just give yourself time, right? And you got to know that things take longer now. It just, that's a natural cause.
So what would be a good closing time to assign to a property if you're purchasing?
So my recommendations for my clients right now is I always say try to give yourself at least 10 business days for condition of finance, right? Especially if you're looking to get like the best market rates, like, dealing with the best lender out there to kind of give you that flexibility. 10 business days. Okay. So call it 2 weeks. For closing dates, be careful with this one. Quick closes are not permitted now. Okay. There's some lenders that will do it. But when I say quick closing, this is closings earlier than 30 days. So if let's say you see a home today and, you want to put an offer in and close on it in 2 weeks, forget about it. You're not going to get the best lending options, period, end of story. So just make sure that your closing date is at least 30 days out, so a month out, just to give, again, the lenders ample time to work on the deal, an appraiser ample time should they need to appraise the home, and your lawyer, right? If you see a lawyer, hug them, right? This is a crazy month for them. They need a hug. It's crazy.
Oh, there you go. Be organized, get ahead, and know where you stand before you make your offers.
Perfect. Well, thank you for another episode, Kim. And look forward to touching base with you again next time.
Thanks, guys.
Okay.
Thanks again, Kim.
Take care.